We got some massive news for UnitedHealth stock investors as the company recently held a conference call with Wall Street analysts and revealed critical insights about the latest developments inside the company. I'm going to share with you those details here and describe what it could mean for UnitedHealth stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's management team tried to summarize the difficulties it's having and saying, in short, most encounters are intensifying in services and costing more. That's what's causing the business to decline the way it has. Of course, the stock price is down over 53% year to date in 2025. And that means people are visiting their doctors more often. And when they are visiting the doctors, they're needing more service than usual. And that is something the company miscalculated. They didn't think it was going to be this bad or this much. And if they had known, they would have bid higher prices. They would have tried to price the premiums higher so that they can be compensated for the increase in service that people will seek out. The management team went on to say that I had initially assumed Medicare Advantage medical cost trend of just over 5% when thinking about our 2025 bids. But we now expect the full year 2025 to be approximately 7.5%. So they initially thought the cost increase would be just over 5%. It turns out it's just over 7.5%. So the cost increase is actually 50% higher than the management team initially projected. And of course, since their pricing policy is not flexible, they can't go and change that now. They have to wait until next year when they can change their pricing policy and account for the accelerating high cost to serve. And of course, unfortunately, people will likely be paying higher for healthcare next year and probably the year after that, and the year after that, and the year after that. Healthcare costs here in the United States for decades have been increasing at a rate much faster than the rate of increase in inflation, as the medical system is all discombobulated here. Between who's paying and how you're paying and getting insurance through your work or getting insurance through the Affordable Care Act, through different systems. It's a mess. And so consumers have been complaining, and recent legislation in the Big Beautiful Bill has even more changes in the system, so it's not likely to improve anytime soon. So to counter these trends, what the management team is doing, they said, is to strongly respond with pricing for 2026. So they're going to raise prices, and they're going to raise prices meaningfully in 2026. And they said they're okay if their price increases result in losing members and losing customers. They're okay with that because they need to protect their profit margins, because their profit margins are falling quickly. And if they don't protect their profit margins, they won't be in business very much longer. So they need to be a profitable business in order to be sustainable. Additionally, they're intensifying their remediation actions. One way they're doing that, not to be left out of the big artificial intelligence trend, they're saying they've scaled their AI efforts across health plan operations, which improves the patient and provider service experiences while driving cost savings. If there's ever a business that's in need of AI to help improve efficiency and operation, it could be United Health. Now, I don't know if the AI that's available in the market today can be what the company needs to improve their purposes. But one company I'm thinking about is Palantir, right? Palantir is a best-in-class AI provider that uses a company's proprietary data combined with artificial intelligence to improve efficiency. And United Health can certainly afford a company like Palantir. So I'm wondering if they're already working with Palantir, but if they're not, they should be working with Palantir because this is a company that needs operational performance improvement. And I think Palantir is the best in class in this category that can help a company like United Health Group improve the performance of its operations. By the way, this document I'm reading from is the company's most recent earnings call transcript with Wall Street Analyst. This was released on July 29th. I made this highlighted document available for my channel members. I have more than 2 dozen company conference call highlights. These are my research, and the things I highlight are the things I see as being important, critical for investors to know. It helps saves you time. This is a 43-page document, right? So by highlighting things, you don't need to go through the whole conference call transcript. It saves you time so you can learn the most important things about the company. If you're not a member yet, you can see in the description, there's a link where you can learn more about becoming a member. They went on to say, looking ahead to 2026, our pricing strategy is intensely focused on margin recovery and moving back towards their earnings growth targets. And if you're not already aware, the company has talked a lot about their long-term earnings growth targets are to grow earnings per share between 13% and 16%. Now, if they can do that from this point, from where their current market price is, if they can return to double digit, even not even 13%, but if they can just get 10, 11, 12% earnings per share growth over the next 5 to 10 years, that will deliver great shareholder value, in my opinion. I think the share price will appreciate significantly if UnitedHealth over the next 5 to 10 year periods can grow earnings per share each and every year by at least double digits. I think shareholders will be very happy with the returns on investment if they are able to achieve this kind of earnings per share growth. So, with the changes from the Inflation Reduction Act, which was passed by then President Joe Biden on the Part D program, which resulted in higher revenue but did not impact earnings because the cost increased to match the revenue increase. The equivalent target margin range is in the 2% to 4% range. So they're working to get back to that level, and they think their changes that they made will enable them to be at the lower end of that targeted margin range in 2026 and improving in 2027. So they said 2 to 4% is their longer term target margin range, profit margin range. They think in 2026 they can get to around 2 or 3%. They don't think they can get to 4%. They think 2 or 3% at the most, and then going higher in 2027. That's what the management team is hoping they can achieve. Again, this is just hope, and they think that their changes, they're offsetting, increasing prices while controlling cost, using some AI initiatives to find efficiencies. They think all of those actions combined will lead to the company improving its operating profit margin in 2026 and then improving it again in 2027. And I think that's a realistic target because much of their difficulty, much of the challenge this year is a result of not anticipating the accelerating costs. And now they know that. And I think they're going to overcompensate going into 2026. They don't want to make the same mistake. They'd rather make the mistake of pricing too high rather than pricing too low and experiencing this same problem in 2026. So I think they're going to increase prices meaningfully. And so they might lose some business as a result. They might lose some contracts as a result. However, their margins are likely to improve and they're not likely to experience this problem again in 2026, which is good news for UnitedHealth stock investors. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.